Hello and welcome to InvestFlow, your YouTube channel for qualitative stock analysis. My name is Niklas. I frequently get asked on Twitter to show my portfolio and talk about my holdings, so I thought why not just make a video about it. So here we go. In this video I will talk about the goal of my portfolio, about the regions or the countries I'm invested in, about the categories of companies I invest in. Then I will of course show all my holdings, talk about my checklist and also my watch list. My portfolio has four main goals. The first goal is to build wealth over a lifetime, and for that I don't want to focus on dividends, at least not now with 23, but rather focus on total return. I also want to have a high conviction in all of my holdings, so that I can sleep well at night. Because if you own companies you don't understand, then you will get nervous and possibly even sell in the worst timing if things go down. Eventually, I want to have the goal of financial freedom. Let's take a look at the regions where my companies reside. I wanted to have a nice split between emerging countries and developed countries. So I have around 80% between the United States of America with 51%, Europe with 17% and 7% in Canada, and around 20% between Asia and China and also Latin America. I try to segregate my companies into 5 different segments. The biggest segment here is American technology, which includes SaaS companies and software companies for the most part. The second biggest category is high growth, which often is unprofitable in most cases. The third category, which is pretty much on par with the second category in the portfolio size, is great capital allocators, so companies with a strong track record of allocating their capital effectively. I also have around 10% in China, and the remaining 9% are just labeled others. So let's take a deeper look into each and every segment I mentioned. The first segment and my biggest one is American tech, which for me includes Alphabet, Amazon, Microsoft, Adobe, Salesforce and Viva Systems. From these companies I expect moderate growth rates and revenue. I expect a deep and expanding total addressable market. I expect a deep and expanding moat, high cash flow generation, if possible a founder-led business, which for these is only the case in Salesforce and Viva. And I also expect high optionality and that they are spawners. So that means that they deploy capital into creating new business segments which are low risk because it's a small part of the invested money into the company, but could grow into something big. Best example is probably Amazon's AWS, which nowadays contributes around 50% of profits. My second segment are high growth companies. These for me include Fiverr, Teladoc Health, Mercado Libre, Z Limited and Spotify. I expect high revenue growth rates for these companies. I need them to be in a secular trend with a huge total addressable market, which pretty much means they need to be in an industry which is growing fast and will stay relevant and disrupt the future. For Fiverr, this is the gig economy and freelancing. For Teladoc, it's the digitalization of healthcare. Mercado Libre and Z Limited operate in fintech and e-commerce. And Spotify is a platform for the future of audio. They also need an early sign of a moat. This can be the biggest network in the space, this can be a great market position, and yeah, most of the time it's a network effect. They also need to hash cash reserves or have a low cash burn rate, because especially in this environment, which is very hostile to unprofitable growth stocks, it is very bad if they have to dilute shareholders. So if you look at these companies, Fiverr, Teladoc, Mercado Libre and Spotify are around break even, and most of them are even cash flow positive. The only outlier here is Z Limited, which are writing huge net losses. But then again, they also are free cash flow positive, so there's that too. Then I also want them to be founder-led, which is not required though, because Teladoc is not founder-led anymore. But Fiverr, Mercado Libre, Z Limited and Spotify still are, which is nice. The third segment for me, and also the one I'm currently doing the most research in, are great capital allocators. These for me include Constellation Software, Texas Instruments, Danaher Holdings, Sartorius, and ASML. The revenue growth is not as important for me in these companies because most of them are established businesses and don't have the same high growth opportunities as the other two segments have. They need a deep and widening moat because, in my opinion, in order to effectively allocate capital, you need to have that. They also need a long track record of great capital allocation. So that means I have to research the management and need to find out if they have a track record of allocating the revenue and the profits they get well, and especially that they are disciplined in this and don't do a lot of rash decisions. Then they also need high and expanding margins, which often is a result of great capital allocation. They have to be an industry leader because, in line with a deep and widening moat, you should be an industry leader. And they also need high returns, which can be measured, for example, on return on equity or return on invested capital. The fourth segment for me is China. This used to be a much larger segment for me with around 25%. Right now I only have JD.com and Xiaomi in this basket. These companies need to not be in the regulatory crosshairs of the CCP. They should preferably be a low margin business, at least in their main business, because I think that also contributes to not being in a regulatory crosshairs as much as the high margin businesses. They need to have an international expansion plant, at least plant, and they should have a low valuation. In the last year, I realized that I underestimated the Chinese government a lot with all the stuff they did, and they did ruin a few of my invest cases in other companies, so yeah. China does offer a lot of potential though, in my opinion, still. Especially looking from a macro perspective, it will become the largest economy in the world eventually, so I want to have some skin of the game some skin in the game here. The other companies I have are for once Nintendo. I like them because they have a unique market position. They don't really compete with anybody in the gaming market, as they said themselves. They don't compete with Xbox, they don't compete with the PlayStation. They just do their thing, they have their loyal fan base, which will buy pretty much every new release for a lot of these titles. They are currently undergoing a transformation, going from a gaming company to an entertainment company. So eventually they could be something like a smaller version of Disney with movies and entertainment parks popping up, which are already in the works. So I see a lot of opportunity here, but a lot of execution risk too. But since they are Japanese, they also have a low valuation, so I like the risk return potential here. Then I also have BlackRock, which is the largest asset manager in the world, currently holding around 10 trillion in assets under management. They are probably the biggest benefactor of the ETF trend which is going on right now, which is rapidly eating market share. And they also have probably one of the best supercomputers in the world with Aladdin, which does a lot of risk management in the financial world. Before I continue to showing my complete portfolio, I want to quickly ask you to thumbs up the video and subscribe. I also would appreciate any comments you have, any opinions on my portfolio, maybe if you hold some of the companies, and hope you enjoy the rest of the video. Thanks. So this is my full portfolio. The biggest position is Teladoc, which I bought aggressively throughout the downturn of the last year. Probably too aggressive in retrospect, but you live and learn. The second biggest position is relatively new, actually, with Constellation Software. Then the third largest one is Mercado Libre, which I also bought a lot of in the recent downturn. ASML probably is my biggest conviction, so I want to grow this holding even more in the future. Then I also have a lot of other companies like JD.com, Microsoft, Alphabet, BlackRock and Amazon in the 5% basket. In the 4% basket I have Nintendo, Xiaomi, Viva Systems, Texas Instruments and Adobe. And then in the 3% basket I have Sea Limited, Fiverr, Spotify, Salesforce, Danaher and Sartorius. I don't focus on dividends, but I do have some dividend paying stocks in my portfolio. Out of my 20 stocks I'm holding, 8 of them pay a dividend. It's not a big dividend though, and my total portfolio yield, so the estimated dividends I will receive in 1 year divided through the value of my portfolio, is only 0.48%. The highest yield here is Nintendo with almost 4%, and the lowest yield is Sartorius with a measly 0.16%. Now I want to talk about my checklist for a bit. A checklist for me means which companies out of my portfolio I want to have a deeper look into. The first one here is JD.com. It is a relatively big position in my portfolio with over 5%, and I think my fifth largest position. I'm not really sure though if the invest case did is intact though. With the whole crackdown in China, I'm not sure if the optionality is still there for JD.com and if they can freely expand like they want to. So I'll have a deeper look into that. Then I also need to monitor Nintendo, because with the whole transformation there is a lot of execution risk. I need to monitor if the movies are doing well, if the parks are operating well, and if in the next, let's say, 2 years, these new source of revenue will have a substantial or at least a noticeable effect on the results. Then I also have Danaher and Sartorius, which are both in the medical equipment business. I don't understand this business too much, so I need to do more research into the business model and understand it better. Finally, I want to have a look at my watch list. These are stocks I don't already own, but might want to own potentially in the future. I have two companies with the Home Depot and Moody's, which just have phenomenal business models and deep moats. I'm not sure if they are great capital allocators though, so I will have to do research into that and potentially pick them up if the valuation is cheap at some point. Then I also am currently monitoring Games Workshop, which is a pretty niche company. They manufacture figurines and have the Warhammer brand, which has a deep moat, but I'm not sure if the moat is expanding or retracting, because they have a series of questionable decisions in the recent past. In the last 4 years, they managed to increase return on capital and general profitability from a 10% margin to like a 40% margin. So on paper, this company looks amazing, but then again, I'm not sure if it's sustainable or not, or just a quick money grab. Then I also want to take a deeper look into Unity, which has a lot of potential in the future. If this whole metaverse thing will work out, for example, Unity might be one of the big beneficiaries of that. So I hope you liked this video. I will try to keep making these videos in the future and do maybe a monthly update of my portfolio. So if you liked it, consider subscribing and commenting down below. Thanks for watching.